All right, as we end because we get toward the end of this unit 4, we're going to get into some technical stuff that can be kind of difficult because we're talking about economic policy. And there's some pretty technical terminology you have to understand. So we'll have to do a lot of practice on this. You're going to have to do a lot of practice on it in order to really understand it. So 4.23, we're looking at fiscal policies versus monetary policies. Fiscal policies versus monetary policies. Again, this is pretty technical material, but when you understand it, it really helps you understand how the political parties and ideology plays into managing our economy. So it's pretty cool in that sense. All right, so backside flip. All right, so on the left-hand side, write fiscal policy. On the right, put monetary. Make like a T-chart. So a line down the middle of your card. And on the left-hand side, you got fiscal policy. Now, when we're talking about fiscal policy, we're talking about two things. How much does the government spend? Okay, so government spending. And then how much does government tax? So this is controlled by Congress. So you might just want to put underneath fiscal policies, put Congress. Technically president as well, because the president can veto it, but this is pretty much Congress power, congressional power. This is the budgetary power. Monetary policies on the other side. So monetary policy on the other side is a little different. It's controlled by the Federal Reserve. The Federal Reserve was created in the early 1900s by Congress in order to kind of manage the banking system. So the Federal Reserve has a lot of control over what we call monetary policy. And just think of monetary, think of money. I mean, granted, spending and taxing has to do with money as well, but monetary policy has to do with the actual money in the economy, like literally the numbers of dollars that are in the economy. So, for example, Federal Reserve controls the interest rates that banks pay because banks borrow money from the Federal Reserve, and then banks borrow that lend that money to you and I. So banks borrow money from the Federal Reserve at an interest rate, and then the bank turns around and lends that to other people at a higher interest rate. So when the Federal Reserve sets that interest rate, it's influencing the banking interest rate. The lower the Federal Reserve has its lending interest rate, the lower that banks charge interest to you when you borrow money. This can have an effect on the economy because if that interest rate is high, less people will borrow. Thus, less business growth and less economic growth, maybe less mortgage payments, maybe less people buying homes and cars. If the interest rate is really low, the theory is that more people will borrow because the interest rate is lower. Just a technical term, the interest rate that is lended to banks by the Federal Reserve is called the discount rate. The discount rate. And so that's the discount rate is the interest rate that is charged to banks. Again, let's say the discount rate was 2%. A bank's not going to charge you 2%. They're going to charge you more than that. So maybe they charge you 4%. Maybe they charge you 5% because that's how a bank makes money is off its interest that it charges on loans. All right. Also, the Federal Reserve will attempt to control the money supply. So how much money is in the economy? So they have a right to, either flood the market with more dollars, which of course will encourage lending because interest rates would be lower, or they can restrict the amount of money in the economy, and therefore there'll be less money to borrow, and then therefore theoretically the economy would slow down. Why would they do that? Well, to fight inflation. Inflation is the amount that dollar is worth. So inflation is the dollar being worth less. When the dollar is worth less, you need more dollars to buy things. And so if the inflation goes up too fast, that means prices are going up fast. So inflation going up means prices going up. And if prices go up too fast, the economy will crash because people will stop buying. If you bought, a Coca-Cola for $1 and suddenly the price shot up to $5, you might not buy Coke at all, and suddenly Coke crashes. That would be an example of inflation. So inflation, by the way, just remember, it's the rise in prices. And generally each year, if it's 2 to 3%, that's kind of a good managed inflation rate. That's not too high. It goes up a little bit, but not much. But if it goes up 10%, that's terrible. There's also something called deflation, which when economy is bad, people stop buying, so prices drop. And deflation is considered bad as well because it's an indicator of a bad economy. So Federal Reserve, just remember this, Federal Reserve is controlling interest rates and the money supply. And by controlling those things, they're able to control or attempt to control inflation. All right, so and then the fiscal policy is just Congress taxing and spending. All right, that is fiscal versus monetary policy. The one other thing, the overall view of this is that the reason that we have the Federal Reserve do this is to attempt to manage economic ups and downs. The reality is that we still have economic ups and downs. So the Federal Reserve is not perfect by any stretch of the imagination. What it's trying to do is attempt massive depressions, like the Great Depression from the 1930s. That's the hope anyway. All right, so that's monetary policy. All right, 4.24. Let's talk more specifically about the Federal Reserve and like what it does. This may be a little bit of review from the last card, but that's okay. We need to get really specific talking about the Federal Reserve. All right, pause if you need to. All right, so one, the Federal Reserve is often just called the Fed. So if you ever hear that, that's what it is, the Fed. The Fed. It's an independent federal agency. That means it does not belong under any other department. It is not under the Treasury Department or something like that. It is an independent federal agency. The meetings it has on a quarterly basis, which means every 3 months it meets, they're secret. The notes from the meetings are not released for 3 weeks after decisions. And the reason for this is that they do not want the meetings to be influenced by politics. They don't want the political party in power or a election party who's trying to run for re-election to influence what the Fed does. The Fed is supposed to take its decisions and do it in a nonpartisan way, not to like short-term help one political party or the other. So the meetings are secret and they release those notes later. So that way there isn't like an outcry about the decision they made in trying to influence that decision, whether by the president or Congress. All right, and they determine U.S. monetary policy. Remember, the Federal Reserve, monetary, money, and monetary policy, it has to do with money supply and interest rates. Money supply and interest rates. That's what monetary policy is. So that's a little review from the last card. You can see here the Federal Reserve System. We have the U.S. Central Bank. And then underneath it, there's a board of governors that's appointed by the president to a certain amount of term, and different presidents get to appoint them. Federal Reserve banks are 12 of them regionally, and then there's an open market committee as well. So these people meet. They're supposed to, again, be nonpartisan, very much into data and analysis of actual data rather than politics of decision. And then they're conducting monetary policy and trying to stabilize the financial system. And so the goal is stabilizing the banking system and promoting economic growth. Stabilizing the banking system and promoting economic growth, but not too fast of growth, because if it goes too fast, then you might have a crash, like the late 1920s. But not too slow, because too slow might not mean enough job growth. So there's this balance that they're trying to make all the time, and it's not perfect at all. In fact, let's just look really quickly at the bottom of your card, make a little T-chart and put bad economy, good economy. So what's the Federal Reserve going to do in a bad economy? Okay, what we'll do in a bad economy, what we'll do in a good economy. In a bad economy, it's going to do two primary things. In a bad economy, the Federal Reserve will lower interest rates because, again, that encourages you and I to borrow money, or a business to borrow money, and that would spur economic growth. If you and I borrow money to buy a car, that helps economic growth. If you and I buy a house, or build a house, that's economic growth. So lowering interest rate would help an economy. So a bad economy needs to lower interest rates and then increase the money supply. Why? Well, there needs to be more dollars out there so people can go out and borrow more money. In a good economy, especially if it's getting really fast, then they're going to do the exact opposite sort of thing. They're going to probably slowly increase the interest rates to make sure that the economy is not revving up so fast that it could crash. Remember, the faster prices rise, the more likely everybody just stops buying that good. So they want to keep that they want to keep that kind of tamped down a little bit. They want a good growth, but not too fast growth. So they might raise interest rates in a good economy and then restrict the money supply. They don't want quite as many people sorry about that. They don't want quite as many people borrowing money, so they restrict the money supply. And that means they pull back the dollars that are out in the economy. Restrict, pull it back. All right, so increase or restrict, lower the interest rates or increase the interest rates. So you really need to know that. You need to like go and take your whiteboard and make a T-chart and then put good economy, bad economy, and what the Federal Reserve does, as well as being able to write out what the Federal Reserve's main principal objections. What the main principal actions that it does. All right, great. That's tough stuff right there. We need a lot of practice on it. All right, cool.